Dear students, we have already discussed about theoretical framework of scope of total income or incidence of tax. In that, we have learned that residential status is very important in determining tax liability because incidence of tax is different on assessees of different residential status. Today, we are going to do a practical problem based on that. So let us read the question. Mr. Anto has the following incomes during the year 2019-20. Income from salary in India from a company in USA, rupees 5,50,000. Income from house property received in India, rupees 20,000. Income from a business received in England and deposited in a bank there, rupees 10,000. Income from business in Kolkata managed from USA, rupees 1,20,000. Income from business in USA, rupees 12,000, and it is controlling from Chennai head office. Income earned in Australia and received there but brought into India, rupees 25,000. Compute the gross total income if Mr. Anto is ordinarily resident, not ordinarily resident, and non-resident. For doing this kind of problem, we have already stated that an easy method of studying incidence of tax is by preparing a table. For refreshing those rules, once again I will tell you those rules. Okay? Income received in India, it is taxable for ordinarily resident, not ordinarily resident, non-resident. Income deemed to be receiving in India, it is taxable for ordinarily resident, not ordinarily resident, non-resident. Income arising in India, taxable for ordinarily resident, not ordinarily resident, non-resident. Income deemed to be arising in India, taxable for ordinarily resident, not ordinarily resident, non-resident. Income receiving and accrued outside India from a business controlling in India, it is taxable for ordinarily resident and not ordinarily resident only. No, and for non-resident it is not taxable. Income receiving and accruing outside India from a business controlling outside India, it is taxable only for ordinarily resident. Income received and accrued outside India from any other source, it is taxable only for ordinarily resident. Income accrued or arisen and received outside India in earlier years but later on remitted to India during the previous year, it is not taxable for all the three categories. Okay, so these are the rules. Now let us start doing the problem. For answering this kind of problem, first of all you have to draw a table like this and insert these columns: serial number, income, income details, then 3 columns: ordinarily resident, not ordinarily resident, and non-resident. Then you write each statements shortly in the table. Okay. First one, income from salary in India from a company in USA. That means income is arising in India. That is, it is taxable for all the 3 categories. So you have to write 5,50,000 in 3 columns: ordinary residence column, not ordinary residence columns, and non-residence column. Second one, income from house property received in India. That means income is receiving in India. So rupees 20,000 is taxable for 3 categories. You write 20,000, 20,000, 20,000. Now third one, income from a business received in England. That means receiving outside and deposited in a bank there. It is also deposited in a bank outside India. It's not in India. So it is taxable only for ordinarily resident. So you write 10,000 in only ordinarily residence columns. Then fourth point is income from business in Kolkata managed from USA, rupees 1,20,000. That means income is arising in India. So you can write 1,20,000 in 3 columns. Next one, income from business in USA. That means income is arising outside India. But business is controlling inside India because it is controlling from Chennai head office. That means it is taxable for ordinarily resident and not ordinarily resident. So you write 12,000 in ordinarily residence column and not ordinarily residence column. Next one is income earned in Australia, received there but brought into India. That means income is receiving outside India. So it is taxable only for ordinarily resident. You need to write rupees 25,000 only in ordinarily residence column. Now you can add these amounts, and finally you are getting 7,37,000 for ordinarily resident and 7,02,000 for not ordinarily resident and 6,90,000 for non-resident. So gross total income of Mr. Anto, if he is ordinarily resident, is 7,37,000. If he is not ordinarily resident, his gross total income is 7,02,000. If he is non-resident, his gross total income is 6,90,000. Okay, hope that you understood how to do the problem based on the scope of total income. Okay, thank you.